This is another episode of me sticking my nose into the charts every single day until I discover a trade model that makes me millions and millions of dollars. And I hope that you're doing the same. And I hope that if you're watching this video, you get inspired to do the same if you're not already doing so. So let's get into it. All right. So, first of all, let's talk about how this week's been going. So it's only Tuesday. We're 2 days into the week. We still have 3 whole new trading days, 3 beautiful new opportunities to continue to get better. But as you can tell, I'm off to quite the rough start this week. Now, I got 3 observations incorrect yesterday. Yesterday was pretty rough. If you look at the conditions yesterday, you could probably tell why it was rough. Let's go to the 15-minute time frame. And here's yesterday's conditions, right? So here I am taking 3 trades and stopping out on all 3, trying to do something in these conditions. So yesterday was a lot of lessons learned on approaching high resistance liquidity conditions. Yesterday was not a day that I should have engaged in at all post 9:30. So a lot of lessons learned yesterday, and today not as much damage was done. You can see I only got 1 incorrect observation, but today also revealed a huge lesson. So if you can't tell, I just keep repeating myself because anytime that I have a losing day or what you would consider a bad session, I just tell myself, I learned a lot, okay? And that's how you simply have to view your losses. So recently in my trading, I reached a whole new point of maturity where I appreciate the value that my losses bring because they reveal so much insight about yourself and the market. And I repeat this over and over and over again. I literally say this in just about every one of my videos and all the reels that I also post on my Instagram because I'm trying to drill this into your head. I'm literally trying to program you to think this way, okay? Because if you think this way, you can't let your losses defeat you. Literally, my ego is completely out of the way, and when I get it wrong, it doesn't even bother me. So the whole point of me taking demo trades right now is to desensitize myself to the outcome. You're literally just supposed to get in there, push the button, right? Practice marketing in, getting into that trade, getting uncomfortable, and seeing how it feels because actually pushing the button, that's going to reveal a lot about yourself and how you react emotionally to actually being in a trade. So I started that last Tuesday, and initially I felt, a bit of anxiety. I'd stop out, kind of feel that ick feeling like, oh man, I got it wrong. I stopped out, but now I am completely desensitized to getting it wrong. Like literally, I stop out and I get it wrong, and it doesn't affect me at all because I simply view it as a learning opportunity. Now, I haven't had the time to go back and study all my observations that I've got incorrect because I've just had so much going on outside of trading itself. Like all my social media accounts are starting to see some growth, so that's good. And if you're supporting me, I really appreciate it. I appreciate you subscribing to this channel or following me on Instagram or joining my Discord. Any one of those 3, I really appreciate it. Appreciate all the support, the positivity, and the feedback. I hear that I'm inspiring a lot of people, and I love to do that. That's my whole intention behind this. Anyways, I don't even know how I got on that topic, but the whole point of me repeating this over and over and over again is I'm trying to program you to view your losses in the correct way, okay? Because when I was a beginner trader, I've been trading for a year and a half now. And now when I was trading supply and demand, when I was coming to the market every single day wanting to make some money, man, when I would get it wrong, it would bother me so damn much. If I had a bad session, I had a bad day, literally. And that's how you know that something has to change. If you have a bad session and the rest of your day is shit as a result of that, then you have a lot of work to do, okay? You have a lot of introspection to do, meaning you need to take a look at what is going on inside you, and you need to dig deep and find out what that is and fix it. Like for me, we all have emotional baggage that we carry into trading. Me personally, I only have a certain amount of money that I have left, and trading has to work. I have to start making money trading, or I'm simply going to run out of that money. And I only have a limited amount of time to make it before I get kicked out of my parents' house and I have to go find a place to live on my own, right? So those are 2 external pressures that make me feel emotions when I come to the market because I want to start making money right now because of those pressures. And because of that, I feel emotions when I take losses. Like when I take losses, I mean, it hurts, right? It feels like a setback. But recently, I dug deep inside me and just you have to get real with you have to get really, really real with yourself and be honest and think like, what is causing me to feel this way? And the second I did that, it was like unclogging a drain, literally. all my emotions kind of just they settled. Literally, they're nowhere near as intense as they used to be, and for the most part, they're almost gone. Especially when I take a losing trade. Now I do feel anxiety when I'm in a position, or not when I'm in a position. When I go to execute a position, you always get that little adrenaline rush. That's normal. And when I have retracements against me, that's when I usually feel a bit of frustration or doubt or anxiety. But for the most part, when I take losses, I handle them so well. So I was not even planning on talking about any of that. That just came out of me. So if that helped you, if that helped you perceive losses differently, then I hope I was able to help you out a little bit. So let me get into the actual topic of this video, which is simply just the trade that I took today and what happened. Okay, now let's get started. But anyways, my first and only trade of the day was at Tuesday, 8 o'clock in the morning. Now it was a good trading idea, but the conditions weren't probable. Now, what do I mean by that? If I go to the 15-minute time frame, let me put my executions on the chart. In this video, I'm going to aim to keep it rather short because I have some work that I need to do personally. But anyways, I was executing this candle right here, okay? And these conditions weren't probable because at this point in time, you could frame this trade to the sell side, right? Because we can trade up into this imbalance and roll over. Or if you look below the marketplace, we also have this inefficiency, right? This inversion fair value gap, and this buy side imbalance, sell side inefficiency that could support price. So we could trade up into this and trade lower, or we could trade lower into this. I'll just mark them out real quick. And this, and we could trade higher, right? So when you can't frame a trade idea one way, then it's not probable at all, and it's not a trade that you should take. So that's probably going to be a new rule of engagement that I will implement. If I can't frame it one way or over another, and it's so obviously one-sided, then it's not a trade that I want to take, because we could trade up into this and trade lower, or we could trade down into this and trade higher, right? So it's not probable. At this point in time, it's not probable. Now, it's not until we see a stop run on these lows right here inside of the inversion fair value gap and the buy side imbalance, sell side inefficiency that we actually see a run into these relative equal highs right here. But at this point in time, it's not probable at all. Now, this makes it more probable, I would say, right? Because now we have a stop run inside of the imbalance, which is something that I've noticed tends to lead to good trade setups, is if you have a stop run inside of an imbalance, and that occurs here, and that leads to a run on these relative equal highs, which could have been a target. But on the lower time frame, I don't think there's anything for me to get involved in that move. But anyways, in this case, I just couldn't frame it one way over the other. Therefore, it was a low probable trading situation. That is probably a new rule of engagement that I'm going to implement. I think you should too. Now compare that to what happens down here at the low of day, right? Watching this reaction off of Monday's daily low and the consequent encroachment of this discount wick on the 15-minute time frame, if you see the candles closing above this, right, the bodies tell the narrative, and we have the candles closing above Monday's daily low and consequent encroachment of this discount wick after running out the sell side liquidity here, these relative equal lows, you can't frame that to the short side of the market when it's trading all the way down here. And you see how these bodies close respecting consequent encroachment of that discount wick and Monday's daily low inside of this pool of sell side liquidity. You can't frame that to the downside, right? So that is a probable scenario, and I'll get to that later. But this, let's drop down to the lower time frame. So what did I try it long off of? What was I trading off of? Huh? Sorry about that. Pause. Let's take a look. This is why you journal, folks. So check this out. So this is just a description of the trade. Status, wrong or right. The time I recorded it. How far it moved in my favor. How far it moved against me. How long did it take to begin moving in my favor or against me? How long did it take to deliver to my target or stop me out? The date, the day, why did it not work out? What side of the market was it? And then this, I'm just tracking if it was during a macro or not, or in between a macro. And then what do I have here? The 1 minute time frame. So let's see. Okay, there we go. I was getting long off of this inversion fair value gap, right? Because this was This right here, this up close candle is a propulsion block because we have an order block off of an order block. So once I see the propulsion block violated, that would indicate that something has changed. So I'm thinking, okay, we violated the propulsion block. We have a change in the state of delivery. Once we cross the open price of these down close candles right here, we have an inversion fair value gap. So now I'm buying on a downtick back into the inversion fair value gap, and I'm targeting this high. And that was the idea behind this trade. And I framed it off of that inversion fair value gap on a 15-minute time frame. So this line, and this line is that inversion fair value gap on the 15-minute time frame. I go up to the 15-minute. Where am I? There I am. Right, so here we have that inversion fair value gap right here. And so this dashed line right here is the midpoint, consequent encroachment of that inversion fair value gap, and I liked the reaction off of it. This was also a 15-minute discount wick consequent encroachment. So that was also the consequent encroachment of this discount wick right here, right? Extend that out in time, and I like the reaction literally to the tick off of it. So, I mean, it wasn't a terrible idea. Like, there was some logic behind it, and it was off of a higher time frame PDR, right? Which it has to be. I like the reaction off of consequent encroachment of the inversion fair value gap and the discount wick consequent encroachment, and I was targeting this high. And it was also during the macro, right? So we had the element of time behind it as well. Targeting that high, but it never got there, obviously. Cleared these relative equal highs, and then boom, retraced against me. Now, what's lacking here, I will say, is a stop run. So that might be another rule of engagement that I add to my trade model. See, I'm taking all these losses and I'm using them to refine my trade model. Okay, I'm not taking these losses and being defeated and saying I suck at trading and I need to quit. No, I'm taking them, studying them. Why did they go wrong? And I'm building a trade model out of that. I'm building rules out of that. So here we don't have a run on liquidity. Like I said earlier, I said when you see a run on liquidity inside of an imbalance, that's usually a good setup. Well, what do we see here? A run on liquidity inside of that imbalance, which I already outlined on that higher time frame 15-minute. But here it is on the 1-minute chart. We can see that we have this large imbalance here. Let me just show it here. We have this large imbalance here, right? And this is where we see a turning point right there. So it's not until we see a stop run here, and maybe I could have just turtle soup that low, but I've never done that before. So, oh, here's the real move. It's actually when we run this low right here. But still, we take it from this low right here to this high. This forms relative equal highs, drop down, run the short-term low, then run out those relative equal highs. We have a buy program. How do we know the market's in a buy program? Because look at it just consistently pricing in higher highs, right? Higher highs and higher lows, just consistently higher highs and higher lows. What does this form? Low resistance liquidity. So we can see that we can draw a trend line. That's a retail idea, and I'm going to fade that. So I absolutely love when I see a trend line present in the market because I know that's a retail idea. I know retail is getting long off of that. I know that's engineering sell side liquidity, and I'm going to fade that. So perfect. That's why this trade did not work out. You could frame it both ways, number one. And number two, it was lacking engagement of liquidity. So there you go. Study that loss, and guess what? I got better because of it. Okay, now let's go to the 9:30 open. So at 9:30 open, I see this low resistance liquidity, right? On the higher time frame, I have to start on the daily chart to frame this logic. Let me get my executions out of here. Okay. So from top down on the daily time frame. Now today I was going into the market looking for higher prices. So post 9:30, what do I have to look for? Initially, I want to see a drop down lower because that is the Judas swing. That is the fake move that gets retail thinking it's going one way, the wrong way. It leads them down the wrong way, has them thinking it's going one way, then rakes them across the coals and does the exact opposite. So post 9:30, I was not willing to be involved in that short because my bias for the day was higher. I was looking for higher prices. So I wanted to wait for that initial drop down lower and then look to get long. But I'll outline why I didn't get long later. And it was another huge lesson. Okay, so on the daily time frame, I'm looking for higher prices. Why? Because we have Thursday's large range candle, right? And then on Friday, we see a TGIF, which is just simply a retracement back into the weekly range after a one-sided move, right? Large range candle, Friday opens, trades lower, and it denies this candle of an imbalance. You see, usually a candle like this would form a fair value gap, right? But what do? We open here, we trade down, and we touch this candle's high right here. So that denies it of the imbalance. And what is that? That's an immediate rebalance. So we have an immediate rebalance on the daily time frame. Now that is one of the best on-site indicators that you can use, and that indicates strength, right? So following this down close candle, we have a wick. So mark out consequent encroachment of the wick, and we can see that the previous session fails to trade down to consequent encroachment of the wick. And wicks are treated as inefficiencies. So if we can't reach the halfway point of this wick, which is treated as an inefficiency, that would indicate strength because we're staying in the upper quadrant of that wick. If I put some quadrants on this, see, we can't even trade down to consequent encroachment, and we're working the upper half, we're staying in the upper half, and we're closing outside of it. So act like this was a fair value gap. The same logic applies, right? The same logic that we use for fair value gaps applies to wicks because both are inefficiencies. We treat wicks as inefficiencies. And if we can't trade down to the midpoint, that is indicative of strength. So we fail to trade down to the midpoint. That indicates strength. So today, what I was looking for was acceleration higher up into this high and this high. These highs are relatively equal. That is a pool of buy-side liquidity above that high. This is also the previous week high. And I want to see some acceleration into this high right here, this pool of buy-side liquidity, because these highs are relatively equal. See that? All these highs are relatively equal. So I'm looking for acceleration up into this pool of buy-side liquidity. We also have these clean highs over here. If we look left, look further left, boom, boom, boom. And we also have this sell-side imbalance here. So for a weekly objective, I'm thinking here. Because of this, the immediate rebalance, fail to trade down to the discount wick, relative equal highs, and we have an imbalance right here. So that's my weekly objective. I'm thinking we reach up there. So what do I want to see at 9:30? Initially, I want to see a drop down lower, the Judas swing, the fake move. Get retail traders thinking it's going lower, rake them across the coals. Now, we had a high impact news event at 10 o'clock in the morning. It was consumer confidence, red folder, high impact. So initially, I'm reading this mood right here, right? We can see that my trade model is present. We have a breaker. Let me outline the breaker. Right there. We have an inversion for value gap. So for me to qualify a trade, I need to see an imposing imbalance inversed. That is my first qualifier, okay? And we get that here. Now at 9:30, we open. Initially, we trade higher. We run the buy side liquidity. And this is the mean threshold of an order block on the 15-minute time frame. So go to the 15-minute, drop a fib on this order block right here. You get your midpoint, okay? Now the lower time frame is going to confirm the higher time frame. So on the lower time frame, I want to study how do we react to that. Look where the bodies close. Look where the bodies close, right? Right at it. And if we go to the higher time frame, what does it tell? The same story. Look how the bodies close below it, right? So what does that indicate? Weakness. Now notice how 9:30 we trade higher initially, but look what we leave, right? That is not a coincidence. They leave this intact for a reason, and they're going to utilize that later. Okay, so back to the lower time frame. I'm not interested in this move because my bias for the day is bullish, and I'm waiting for something to indicate that price wants to reach into Thursday daily high, the previous week high, those relative equal highs that we saw on the daily chart, and even potentially up here. So that's what I'm looking for. So I'm not interested in this move. Now, consumer confidence opens and trades lower. And here is where everything kind of fell apart for me for the session, because I didn't take this sell scenario here. Not interested in it. I just outlined why. I'm looking for higher prices. I'm not looking for lower prices. So I leave this. I don't have to trade every fluctuation in price, right? I just want to wait for that one thing that I am looking for. I'm just sitting, stalking, and waiting in the tall grass until I see it. And when I do see it, I jump on it like a predator, okay? Now, consumer confidence opens. This candle opens, trades all the way down. Okay, look at this huge, large imbalance. Now, when I see this, boom, my sentiment is already automatically manipulated. What is news designed to do? News is a smokescreen, okay? Let's define a smokescreen. What is a smokescreen? So I'm going to pull up the definition of smokescreen and we're going to read it, okay? Smokescreen. I don't know how to say this word, ruse. A ruse designed to disguise someone's real intentions or activities. So, news is designed to disguise someone's real intentions or activities. News is designed to disguise or hide their real intentions or activities. So, what is this designed to do? It's designed to drop lower, have everyone thinking, oh, wow, look at that move. It's going lower. Let's sell short. And then what does it do after? Boom, right? So it's a smokescreen. It is designed to hide their real intentions. It is manipulation. Now, I'm being honest, I got manipulated. Okay. I saw this large down close candle and I thought, man, there's no way that we come back up and run these relative equal highs or even Thursday, previous week high. I thought, man, there's no way. After seeing this large of a down close candle, I thought, no way. No way we come all the way back up here. So at this point, we trade down in this pool of sell side liquidity. And initially, I was looking for a long scenario down here. If we were able to get over, I think it was, no, I wasn't interested in a long here because the draw on liquidity was simply the previous day low, and I knew that, so I wasn't interested in a long down here at all. But I kept seeing this heavy order flow, heavy order flow, and I simply I turned the charts off. Basically, I called it a day. I thought I missed the move. I thought this was the real move because of what I saw at 10 a.m. So ended my day there, started recapping, started journaling my trades. And then when my long setup came, I was journaling, so I missed it. And it came during the 10:50 to 11:10 macro. So literally at an element of time as well. So let's outline this entry model on a 1 minute time frame. So right away, we can see that we have a 3 drives pattern. So what does this indicate? An accumulation of longs because we have minor buy side liquidity here. Minor buy side liquidity here. So we run out buy side liquidity 2 consecutive times, and then we tap into the Monday daily low. So it's a 3 drives pattern. 1, 2, 3. Boom. What do we see? Boom. Displacement. Change in the state delivery. We have an inversion fair value gap. Notice all the breakaway gaps. You see how price doesn't refer back to these fair value gaps? It leaves them open, right? What does that indicate? Strength. If price is so strong or so light that it's having such an easy time moving higher that it can't even trade back down to these imbalances, that indicates strength, okay? So this is a perfect indicator that this thing's going to start aggressively seeking that buy side liquidity above because it leaves these gaps open. Okay, that's what you want to see. You don't want to see them traded down too. You actually want to see these PD arrays fail because if it can't trade down to it, that indicates strength. So this is how you literally gauge the strength and weakness of the market by studying. Does it refer back to these PD arrays? Can it even do that? And in this case, no, it can't. So we notice that once we have this inversion fair value gap, trade above it, down close candle, boom. Notice how we stay right in the upper quadrant of that, right? So if we drop a midline on that, we don't even come near consequent encroachment. What does that indicate? Strength. And then we also have this buy side imbalance, sell side inefficiency here. Institutional order flow entry drill. And it's all inside of the breaker. That last up close candle before the turn that makes the stop run. And if we go to the higher time frame, this reversal is also qualified by what we see on the 15-minute time frame. Notice how we have 2 consecutive closes above the mean threshold of this wick. And we treat wicks as inefficiencies, meaning they behave the same way as fair value gaps or any gap or any inefficiency. So if it can't close below consequent encroachment, what does that indicate? Strength. So the main takeaway from today is that news is a smokescreen, but it's not always a smokescreen. Sometimes it can distribute in the direction of the bias, but in this case, it was a smokescreen because our directional bias for the day was higher. So if news trades lower, perfect. That's manipulation. And we know that because the directional bias is higher. So that is it for this one. All right, goodbye.